Well, don't think the problems have gone away. I think that's really the message. And as the other message I've been trying to get over is, there's the 1929 replay that we have today. And the answer is get out of credit, basically, and get into real money. And real money in everybody's common law is gold and, to a lesser extent, silver. But gold is the one which the central banks are accumulating, and ask yourself why they're accumulating it. It's why are they getting out of the currencies that they print? Well, the answer is they have a vision of the future, which, perhaps you might investigate a little bit.
For the first time since 1977, U.S. equities, U.S. Treasury bonds, and the dollar fell together, while gold vaulted to record highs. What was once a stable pattern of flight to quality in U.S. assets has flipped. This inversion is a warning sign that something fundamental has changed. According to a survey from the World Gold Council, 95% of central bank respondents expect global gold reserves to rise over the next 12 months. Market specialist Alasdair Macleod emphasizes growing central bank preference for gold over U.S. dollar reserves, signaling waning confidence in the dollar. He notes the U.S. is increasingly reliant on short-term Treasury bills due to weak demand for long-term debt. Yields on 30-year Treasury bonds have soared this year as investors have demanded more compensation for what is looking like a riskier long-term loan to the U.S. government. These concerns were exacerbated in May after Moody's downgraded the U.S., stripping the nation of its last perfect credit rating. Looking at the market fundamentals, Macleod notes gold remains strong despite the dollar's temporary stability around the 97.5 to 99 range. He believes a further decline in the dollar could reignite gold's upward momentum. In his analysis, Macleod notes that COMEX gold open interest remains low at around 450,000 contracts, suggesting underinvestment. Aggregate open interest in CME gold is now approaching extreme lows, 425,000, that have historically marked lows in gold prices despite a compelling macro case for gold. This underscores our view that gold is perceived as a crowded trade, but is in fact underowned. This is particularly surprising amid the ongoing mega-theme gold's rally is associated with the USD partly losing its store of value function. Concurrently, Macleod underscores silver is seeing strong buying, with open interest hitting 180,000 contracts. However, limited producer hedging this time may let the squeeze play out further. Before we dive into Alasdair Macleod's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the markets. Let's get into it.
Indeed. I think this is a process which has been happening in recent years. We now have a situation where I think there was a chart produced by, I can't remember whether it was the World Gold Council or one of these entities, which showed that there's, in terms of central bank reserves around the world, there's a higher level of gold ownership than dollars now. It's, it's sort of overtaking. I don't know if that's entirely true, but it was a chart which somebody produced on X, which struck me as interesting. Mm-hmm. The other symptom of this is the difficulty which America has in funding its government debt out along the yield curve. It's becoming progressively more reliant on T-bills for its funding, as opposed to, say, 10 and 20 and 30-year maturities. Mm-hmm. Nobody really, apart from tame pension funds and maybe some insurance companies who write that sort of long-term business, nobody else really is interested in buying long maturities. So these auctions are always very disappointing, and it has the effect of quickening the pace, if you like, of the refinancing that's going on all the time. I think it is becoming more widely recognized that with budget deficits running at 6.5% to 7.5% year in, year out, with an underlying economy which is probably not growing anymore, the US is really in a debt trap because it's not getting the potential increase, if you like, in tax revenue to cover the increased cost of borrowing an increasing mountain of debt. Because, the US government never pays interest. It just rolls it up, rolls it up, rolls it up. So this is a debt trap now, which I think is more widely recognized. It's no longer just a question of China deciding that, it wants to remove the dollar from its transactions as much as possible and replace it with the yuan. We've moved on from that. I think there is now a wider recognition that the dollar itself is in trouble. Mm-hmm. And you've only got to look at the trade-weighted index to see, I mean, it looks ghastly. It's very, very bearish. It's hanging around at the moment. I mean, most markets are just hanging around at the moment. This is a sort of summer lull, if you like. It's selling in May and going away. I mean, it's just, I think it's probably modify that and say, just to my mind, when we look at gold, we look at actually an exchange relationship between gold and principally the dollar. Mm-hmm. And so it's the dollar's problems which benefits the gold price in that relationship. I think we've got to bear that in mind. The idea that war is good for gold is not necessarily the case. War tends to be better for, if you like, for the dollar. You find that people are going for a safe haven. And the safe haven of the dollar, which has been traditionally certainly since before the Second World War, and particularly in the last sort of 30, 40 years, that safe haven aspect is something which is, with all the capital that there is around, investment capital that there is around, I mean, that's what you're told. You're told that the safest thing to do is to hold US Treasuries. Mm-hmm. So when you got the threat of an escalating war in the Middle East, what do? You buy more dollars and you buy US Treasuries. So I think that is really where the benefit, if you like, of this disruption tends to go rather than into gold. That said, I think, if you consider the implications of this and assume that we're not going to stop dropping nuclear bombs all over the place, then under those circumstances, you can see that, this is the sort of uncertainty which actually could backfire on the dollar, not so much from the fact that there's, the war is going on, but more from the fact that it's destabilizing US finances. That's the sort of equation that you'd be looking at. I think that as far as gold is concerned, it's had a very, very good run against the dollar. We've got a pause in the dollar, and I think the pause is in the dollar rather than anything else. If you look at the trade-weighted index, I mean, there's been movement out of the dollar into euros and into yen as well, to a very large extent. Those are the two principal currencies, if you like, which are in the the trade-weighted index. And I think that's just gone on sort of pause a little bit. So the dollar has looked very, very weak against other currencies. A little bit of a pause. I think it'll go south again. But of course, the pause is reflected in, if the dollar's pausing in terms of its loss, then the exchange rate with gold will also pause. And that's really all we're seeing. It's interesting that gold is actually holding up extremely well against the dollar. But that's a function of the dollar really just moving sideways, more or less. I mean, if you look at the trade-weighted index, I think we got down to something like 97.5. We're currently about 99, and it's just been moving in that sort of range. Mm-hmm. It could perk up to 100 and test that. In which case, the dollar gold exchange rate will probably mean that gold goes down to, I don't know, sort of 3,200, whatever. So you can see that that's really, I think, what's going on in a very, very quiet time. I mean, if you look at COMEX, gold is not overbought. I mean, this is the extraordinary thing. I mean, we had this run up in gold at one stage to 3,500, just very briefly on a spike. But if you look at the open interest on COMEX, it's been very, very low. Mm-hmm. It's currently just a bit under 450,000 contracts. That is low. A gold price which rises like that, and nobody's buying it on COMEX. I mean, what gives? COMEX is just, it's just not in the equation. Silver is very, very different. The people have been really going for silver. And already we're up to 180,000 contracts, which for silver is pretty high. So it's a big squeeze. I mean, the squeeze is worth around about $9 billion at current levels. spread amongst the swaps principally. Because the other thing that's happened is that the producers, the mines and so on and so forth, have not really increased their net short position by very much. I think that side in the past has been very much banks operating for the Chinese government, because they have, there's no doubt in my mind that they have had a long-term plan of keeping the silver price suppressed.
Alasdair Macleod recalls discovering over a decade ago that Chinese entities were likely behind silver price suppression. He explains that silver miners sold doré bars to China, while JP Morgan sold futures allegedly at China's direction. According to consensus within the precious metals community, the primary culprits behind silver price manipulation are the bullion banks, the most influential players in the precious metals market. These include major financial institutions such as JP Morgan Chase, UBS, HSBC, and Goldman Sachs, several of which have been found guilty of manipulating precious metals markets, particularly gold and silver. However, Macleod notes that since 1983, China's central bank has managed gold and silver via the Shanghai Gold Exchange. In 2023, silver exports went to financial centers, but shifted to industrial users in 2024, indicating a possible policy shift. Signaling a strategic shift, Macleod states China may be ending silver price control while promoting yuan-based trade. New offshore gold vaults in Hong Kong and Saudi Arabia support gold-backed yuan settlement, challenging U.S. dollar dominance. Let's get back to the interview.
I first worked this one out when I had a speaking engagement in New York, and it was about, 10, 12 years ago. Mm-hmm. There were lots of silver mining companies and exploration companies exhibiting at this conference. And I went round them all because at that stage, the sort of gold bug community or the silver bug community was accusing JP Morgan of rigging the market and all the rest of it. And Blythe Masters, lying through her teeth. She had actually at that time, I think it was 2010-ish, she had actually deliberately gone on CNN and said, "We do not take positions for ourselves. We only take positions for our clients." And of course, everybody said, "But I know people like this. I've worked with people like Blythe Masters. They do not lie. I can tell you that for a fact. They will protect themselves in any interview or anything they do." I then knew that JP Morgan was not acting, if you like, to suppress the price off its own book. It must have been doing it for someone else. So my question to all these silver mines was, tell me, how do you turn your silver into cash to pay all your miners and your energy costs and all the rest of it? And they all came up with the same answer, which was interesting. They said, man from Gencore comes along, he values the doré, we get paid for that, and it gets shipped off. So where does it get shipped off to? They said, well, we don't really know, but we assume it's China. Right. We could then see how this worked. In other words, the Chinese would pay for it. Yeah, the Chinese would pay for the doré.
Okay.
And that goes outside the market. Mm-hmm. And at the same time, they would instruct JP Morgan to sell futures to suppress the price. So they managed to keep the lid on the price the whole time. Now, bear in mind that at that time, countries like Canada were closing down silver refining businesses because it's ecologically dirty and all the rest of it, and not productive. And the Chinese, I think, also were doing it more cheaply than anyone else. So an awful lot of silver doré from the West was going into China. Now, China themselves was something like the 5th largest mining nation of silver. So they were also mining it themselves. So they were stockpiling it. Now, the other side of this story, I think, is very important. And that is that back in 1983, the Chinese Communist Party appointed the People's Bank of China sole responsibility for managing the state's gold and silver reserves. And I mean, the Shanghai Gold Exchange, which deals in gold and silver, is a wholly owned subsidiary of the People's Bank of China. So I worked out how they dealt with the gold. That was quite easy. But silver is interesting, and we've forgotten to look at silver. But basically, the People's Bank of China has been in there dealing in silver, buying silver, hoovering up all the loose silver it could get around the world. So it has built not only its gold reserves, but also its silver reserves. Now, silver has been used, as you pointed out earlier, as an industrial metal. But don't forget that from the Chinese point of view, their last metallic standard was a silver standard in 1935. Whereas, Europe went off silver in 1873. So you can see that China's experience of silver is a lot more recent, if you like. And therefore, that's still somewhat in their psyche. I think they look at the gold-silver ratio and think, God, silver's cheap. Interestingly, 2 years ago, I think in 2023, China exported quite a bit of silver. And that silver didn't go to producers of photovoltaic cells. It went to Hong Kong. It went to London. I think it went to Singapore. It was going to financial centers. So they were still managing the price. Now that in 2024 didn't happen. They still exported silver, but that was going to industrial users, basically, presumably for photovoltaic cells and other applications. I think they've taken the view, and particularly since Donald Trump started talking about tariffs and all the rest of it, that, in line with their views on rare earths, they say, right, okay, that's it. We're not exporting anymore. And I think that's created the crisis, a crisis on top of a similar problem with silver on COMEX that they had with gold. I have no doubt that they've got a substantial quantity of silver. They don't tell us how much, just the same as they don't tell us how much gold they've parked around, the People's Liberation Army, the youth wing of the Communist Party, et cetera, and all these various accounts where they've parked, in my view, at least 30,000 tons of gold. We're talking huge amounts. So on that basis, I think the big change, really big change, was President Trump on his Liberation Day saying, with his boards, these are the new tariffs. We're going to charge the penguins 35% in Antarctica, or what and the Chinese. And then he went up to 140. Literally, just following that, China announced that they were going to speed up their trade talks with South Korea and Japan. Mm-hmm. And they also then started looking at their relationship with the other ASEAN nations, the nations, if you like, in East Asia. So President Xi then had a whistle-stop tour the following week, where he went to Myanmar, he went to Vietnam, I think he went, I can't remember whether it was Cambodia, and you got all these big countries with actually a pretty large Chinese diaspora, which are naturally, if you like, in China's pocket in this sense. And what China did, obviously she was talking about, look, we got to get this trade amongst ourselves to really get going, to replace our dependence on America. But the other thing we didn't know, which I suspect is definitely the case, was that she was also talking about the future of the currency, the future of the yuan, and how that would replace the dollar for ASEAN, South Korean, and Japanese trade. And that replacement was going to be facilitated by the Shanghai Gold Exchange opening vaults outside China for the first time. And already we've had one announced in Hong Kong and one announced in Saudi Arabia, whereby you can take gold, put it in, take it out against a currency, only one currency.
In our view, unless institutional credibility is restored quickly, investors should brace for further stress in treasuries, continued U.S. dollar weakness, and an extended bull market in gold. The pillars of America's exorbitant privilege have not collapsed, but they are shaking, and the world is paying attention. Do you agree with Macleod's assessment that the U.S. is caught in a worsening debt cycle? And how might this affect the dollar's store of value function? Drop your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.